Any surprises for you this week?
Well, this is a surprise. We'll have to look at the details of the deal, but having a deal with China has been an important impediment to the market. And now, if this deal is meaningful, that could really allow stocks to move forward again.
All right. So what does meaningful mean? And how long does it take before the market believes it's actually going to happen?
Meaningful means that China will stop confiscating intellectual property, that companies that do deals or joint ventures with China won't have to turn over their intellectual property, that the financial markets will open up, and companies can enter China and do business without a Chinese partner. Those are some of the key elements. I doubt that we'll get all of those at this phase. I think we're more likely to get some minor agreement on some trade practices and the willingness of China to buy our soybeans and other agricultural products. But I don't think it's going to be a broad deal. I think we're going to have to wait for that.
Byron, people are trying to put together a shopping list. If you wanted to get to 3,100 and beyond, détente obviously with China, no flare-up with the Europeans. You get USMCA passed. You end the GM strike. The 737 MAX flies again. Do you think, what else? What else do we need? And is that enough?
Brexit. We need a Brexit deal. That'll.
Does the Fed still need to cut?
I don't. It looks like that's moving forward too. So it looks like everything except the 737 is moving to a better place.
Byron, where does the dollar go from here?
I don't think the dollar goes up a lot. I think we're going to be, lowering rates again. That's not good for the dollar. I think the economy is going to be growing very slowly at 1.5% to 2%. I think the dollar is pretty full here. I don't see it taking a sharp dive down, but I don't think it's going higher from here.
Byron, you mentioned Brexit. Today, Morgan Stanley takes their chance of a Brexit deal to 55. They were at 35 before. How much do you think actually changed today?
I don't know. The key element of it, the real roadblock is Northern Ireland. You have to have a free flow of people and goods in Northern Ireland. That has to be a part of it. So, we'll have to see if they really make progress on that. But I think both the EU and the UK want a deal. Britain has really suffered economically, and the deal hasn't even happened yet. So I think people want to get this done and behind them and move forward.
Byron, we're talking about policies. I want to get your thoughts on politics, specifically here in the U.S. as we've got this 2020 election gearing up and certainly some shifts in the polls among Democratic candidates. You got the impeachment inquiry playing out and all this drama in D.C. right now. How do you think that's factoring into the market, and how big is the risk?
Well, I think the market is assuming right now that there's so much turmoil in the Democratic Party with Bernie Sanders' heart attack. I think Joe Biden has suffered as a result of the Ukraine situation. Donald Trump has suffered too. But right now, I think the market is assuming Donald Trump is going to get a second term in spite of the impeachment because he isn't going to be convicted in the Senate. There are more cards that are going to turn up on this one. So I don't think you can really make a definitive statement. But I think the market assumes Trump is going to get a second term.
Byron, political risk notwithstanding going into the election, all the things that we just talked about going right, if we get all those things checked off the list, it sounds like you think we're more in a mid-cycle. We are, like as Powell said, maybe we are true mid-cycle rather than late.
Well, I don't think I've definitely said on this program that I don't think we're going to have a recession next year. Donald Trump certainly doesn't want to be running for re-election if we're in a recession. The earliest I could see a recession is 2021, and I don't even think that's a sure thing. The way you get out of a recession is fiscal and monetary policy. We already have trillion-dollar deficits. We already have an easy monetary policy. How much easier can it get? So, the usual policy tools aren't there. So I think what the policymakers are going to try to do is use some fiscal spending, some monetary policy to defer the next recession as far out in the future as possible. And that's good for the equity market.
All right. Given the toolkit and how some argue there are a dwindling number of tools in the kit, how much are you spending right now thinking about potential exogenous shocks?
Well, look, the market is always vulnerable to a 10% correction. And but I don't think the market is overvalued here. At these interest rates, I think the market can comfortably trade above 3,000. How much more above 3,000 it can get to really depends on earnings. Earnings have been disappointing. I don't think earnings are going to be strong. I think we'll be lucky to get a 5% earnings improvement in 2020. So I think the market has limited upside, but it does have some upside, and that's why it's surging on the good news today.